This is a production of Cornell University.
Hi, Scott Budde again, and like I said in my brief intro, I've been working for the last year and a half on a project looking at creating a special type of community development credit union focused on small-scale sustainable farms. I thought what I'd do today is just go over a little bit of the just the project itself, and as well as get into some of the research projects that this project entails. But I wanted to start with I call it financing gaps, us versus them. And I think many people asked me, sort of as I entered this sector and got to know some of your organizations and small farmers in the Northeast, about my opinion of financing gaps coming into it sort of new. And I wanted to come up with some way of explaining it to other people. So I'm kind of trying it out here. That's this assistant. Just a little bit about what the actual idea is of this credit union, and it has the name Better Harvest Federal Credit Union. And then get in a little bit into the research. I won't spend too much time on the research. I'm happy to talk about it. These were individual research projects within this overall research project. Summarize the pros and cons of a credit union structure just in general, and then talk about the next steps. Okay, so imagine really cool animations of things like coming onto the screen, but they're not there. Okay. No, it's a Mac to Mac thing. It's the recording software, I think. Yeah. Okay, so this is the way I started explaining to people, and I wanted to come up with like a diagram, and it had all sorts of cool little builds to make this. But if you were starting a small business in the U.S., and you were doing any sort of standardized business, a print shop, an auto body shop, a small marketing consultant firm, all sorts of different types of businesses, you would probably start, like most businesses with, startup, you would start with, you draw down your credit card, you'd have sweat equity, you'd have savings, your friends and family, you might draw on a pension plan, something like that. And that's pretty much true for almost every small business, even ones that become enormous. Now, if you're in a pretty standardized part of the economy, you're in a sector of auto body shops. If you're in an auto body shop, you own a bunch of Burger King franchises. This business looks like the same in Maine as it does in California, Florida, Alaska. It's the same. And if you call up Chase or Wells Fargo or Amex, they can call up a little scorecard that says, how do auto body shops work? And they can run you through the checklist, and they can probably approve you for a loan on the spot. It's a pretty standardized business. So when you get to a growth stage, you just happen to have all of these options available to you in that nice standardized business, of which there are tens of thousands of you just like that all over the country. You get banks, you get credit unions, you have government programs. The SBA is just one of an example. You have all sorts of asset-based lenders that will finance receivables or inventory, vendor financing, venture capital, and private equity. You have all these different boxes. And some work for you, some don't, but you have all these different options. And if you're growing and you're managing your business okay, all these doors just sort of start to swing open for you. Plus, you're very standardized because there are lots of other businesses like you. So to a bank or some of these other boxes, they can look at you and they're like, I know how you work, how that works. In the small farm, and this Better Harvest was supposed to come up last, but generally in my brief work in the sector, this sort of startup stage looks pretty similar. No matter what business you're starting, whether it's the auto body shop or a 20-acre farm doing heirloom tomatoes, those are difficult businesses to start. Starting a small business is very difficult. They fail at a high rate. It is very difficult for anyone. But these boxes look pretty similar. But then when you get to the point where you're growing and your model is somewhat successful, the boxes start to look very different. You certainly still have government programs like FSA or maybe the Farm Credit System, the co-op, or you do have loan funds. grants, there's crowdfunding, there's vendor financing. But these boxes are very, they're much smaller. They're harder to access. They're very diffuse, and there are lots of reasons for that. I mean, many of you since you all work in the sector, you probably know the reasons. But I think the two biggest ones, when I have to explain it to some of my friends who ask me, what the hell are you doing? I would just say that the two biggest reasons why there are all these gaps, and that comes up in a lot of the research, is really that the business models are very, very different. There are a wide range of business models, and they are very geographically spread out. So, and there may be thousands and thousands, but there aren't hundreds of thousands. And they're very, very different from one another. So if you're Chase, even if you cared about small sustainable agriculture, which they probably don't, but it's just a wild guess, that they can't call up a checklist to do it because it's hard. There are a lot of things that they don't know. And they aren't going to know what a CFA is. They aren't going to know there are going to be some weird revenues and expenses. Plus, all those business models are going to be quite different. And the idea was, this was supposed to pop up at the end and not quite so arrogantly positioned like this, but was, the two biggest blocks that are missing here, two big blocks, are banks and credit unions. And banks and credit unions don't want too much to deal with this sector. And it is different in different parts of the country. Just a quick, fairly local story. How many people have been in Pittsfield? It's not too far from here, actually. Okay, on, I think it's South Street in Pittsfield. If you're driving south, or North Street, actually, if you're driving north out of the center of Pittsfield, there's a big column, old bank building on the right. It's the First Agricultural National Bank of Pittsfield, which, if you think about that name, First Agricultural National Bank of Pittsfield, seems very weird. And it was chartered in the early 1800s, like 1808, 1810, very early, when Pittsfield was probably a pretty remote. Yes. So just a bit about the model. The model is basically credit unions have to be organized around a specific type of membership. Employment, geography, associations. Geography cannot be too big if it's a geographic model. So that's out for this sector. Employment is out because people work in small groups or for themselves. However, you can do an associational membership. This is very unusual for credit unions, but it can be done. In the past, it was done for religious orders or a union or something like that. And the hypothetical business model that I've been working on is one organized around the NOFA chapters in Montana. But it could include like-minded membership associations. And these happen to have about 12,000 members. About 9,000 of them are consumer members. I sometimes call them foodie stakeholder members. I mean, that would be me, for example, in NOFA New York. I'm actually a member of all of them now. And then there are about 3,000 small farm or business members. Most of them are farm members, actually. Okay, so, but there were a lot of questions. Is it the right structure? Does it help fill this gap, et cetera, et cetera? And it led to this project, this Sustainable Agriculture Credit Union Research Project, which consisted of 3 sort of mini studies to answer those questions. Since I'm now in like 3 minutes, it's like one a piece. The first was, and this was as much for my learning as anything else, was just to sit down and talk to those farm members, introduced by the executive directors of all those chapters. I didn't just like show up at a farmer's market and say, hi, I'm Scott, can you just talk to me? I would go to Kate and say, Kate, can you give me some names of farm members of NOFA New York, and talk to them. And that led, can you see the outline of, that is the Northeast. Yes. There. And that led to this series of interviews. These were very in-depth, 3-hour interviews about their history, goal, financial lives, and what those gaps really are. So there's a fair amount of research on the gaps at a high level. Yes, there's a financing gap. Yes, but what is it, and what does it look like, and what's really needed? And that's what those were geared toward. I'll just say the focus ended up, sorry, this is a lot of text, the focus ended up being on, really on mortgages and the issue of land access, where In that sample, not one of those farmers had any sort of mortgage with a conventional institution. Look, many of them didn't want it. Many of them were on different land arrangements that didn't require it, but several did and couldn't get it. Some of the banks, local banks and credit unions just weren't going to give me a mortgage. I need to find a mortgage before my short-term lease from a land trust runs out. We were lucky I could borrow from my parents. I really don't like the variable rate on my farm credit mortgage. We started with seller financing, which we couldn't get today. Just some quotes about the issue of dealing with institutions around around mortgages and this land access issue. The second was a membership survey, which the credit union regulator in Washington requires you to do if you're considering a new credit union. And that happened. You have basically you have to get a survey. They tell you what the survey should look like. You can change it a little bit, but not too much. And that was done. That survey was filled out in the end by 617 people at the NOFA Summer Conference, my shirt fiasco, and at the Common Ground Fair. And most of those were NOFA members or MACA members, some potential members. And this basically just showed a very high level of interest. This figure of 77% being interested in the idea of joining is extraordinarily high by credit union standards, extraordinarily high. There are more deposits in the region to finance the sector if you could create the structure. There are enough deposits for 50 years of lending. People even willing to volunteer. Lots of people providing detailed contact information. And it also confirmed small farm mortgage demand as being possible. This is about $9 million in this sample, which if you extrapolated it to that membership would be about 180 million. But a lot of that would be like consumer mortgage, normal mortgages. Maybe only a quarter of that might be farm-related mortgages, and then some of that would be underwritable. You could approve it, and some of it probably would. But it confirmed the mortgage issue is access. We also checked whether people, because it would be covering such a large area, to get that critical mass of the sector, you can't have branches. So how amenable were people to working over the internet or the phone? And the internet came out very high as people's willingness to use the internet for kind of some basic banking services. On the last one, and then I'm probably over already. I'm now on the board of Slow Money NYC, and I joined the board of Slow Money NYC after relentlessly criticizing them on a number of issues, and finally they just said, well, you know, whoever says the dog stinks has to get the bath, and they said, oh, why don't you join the board? And I'm like, oof, I get it. And one of the things I had with them was about the definition of local. And I went back and forth with them about, you know, you really want to define the New York City food shed at like 50 miles? And I'm like, I'm not a food expert. We're like starved to death. And I went back and forth with this. And I'm like, do people really think about local that way? And the answer for a lot of slow money people might be yes, they do think about local as being very local. But I wanted to be like, well, how do other people think about local? Like and there wasn't a lot of research. So this was actually really an interesting part for me. We did a survey with Grow NYC at the Union Square Farmers Market, which I realized is not typical of anything except that Manhattan. But it's a lot of money, a lot of wealth. It's fairly typical for inner city, wealthy market. And we asked them all sorts of demographic and use questions, but one of them was, how do you define local food at the market? And just ask them this question. We gave them all these answers. And starting at the bottom, within 100 miles, tri-state area, New York, New Jersey, Connecticut, within New York State, anything at the market within 250 miles, within the Northeast, within the USA, don't know. And in the end, I've added them up to kind of support my own view, I admit, completely. 79% said a definition that crossed the state boundary, right? Because 250 miles, you're in like southern Vermont, right? 50 miles, even you would be in New Jersey or Connecticut. So this to me supported, and I was looking at a regional model, so I didn't want to work on a regional model if no one wanted a regional model. And this said a regional model was very, I can talk about these pros and cons for a while, so I'll just talk about the pros, really. The credit union structure, which is a nonprofit, tax-exempt cooperative, it plays and is received very favorably within the sector. It can offer some products to fill the gap. It can't do everything. It can't supplement for government programs. It can't supplement. It can't do very progressive, you know, very early stage farm lending, something like that. But it can do something. It can certainly address land access as an issue. It can be a bit more flexible. It can certainly be member oriented. There's a vast deposit market in the region. There's $2 trillion in that region. And this field of membership is officially, in writing, acceptable to the regulator in Washington after hours of mind-numbing negotiations with lawyers over bylaws, which is done. And that was to me, a big accomplishment. Hideously boring and thankless, but that is done. And that is a big deal because that means you can create a regional or even national organization focused on the sector. There are lots of challenges, and I don't need to tell you the next steps. I had this long, detailed thing, and I thought, you know, it's sort of talk, network, plan, lobby, grovel, which is probably the same as it is for all of you. It's like the same next step. And I'm certainly happy to talk about the next steps when I'm 4 minutes over my 20. Okay. For me? Oh, good. Great. Questions? Sure, please.
Why is Pennsylvania?
Good question. First of all, it absolutely could be. The minimum requirement, I'm going to try and answer this as diplomatically as I possibly can, but when I slip up, the minimum requirement for a base of new members for a new federal credit union, and I think last year only 2 new credit unions were approved in the whole country. This is not an easy process at all. A lot of money, a lot of time. It's 10,000 potential members. So you can know, long gone are the days when, you know, you could have like a bake sale and start a credit union for your church. 20 years ago, you could do that. You can't do that now. You have to have 10,000 potential members. And at that geography, you get to 10,000. So, and I was coordinating with all of those chapters already, and I didn't have the energy to add more if I was already over 10,000. It's like the worst answer you could give someone. But I would say, you know, PASA is exactly this. It's the same type of organization. It's the same structure. It's the same type of members. It's everything. So PASA, MOFA, DOFA, Maryland, Delaware, you know, all of these are they are like-minded organizations, and you could add them very easily to this now. You would not need regulator approval. You would only need to change the bylaws of the organization. It'd be quite easy. Yeah. Cameron.
And on Scott, on the small mortgage, small farm mortgage, what size is okay. So.
Well, we worked with roughly $50,000 to $500,000 as a size, and that would put it, I think, at the lower end. I'm not a farm credit or FSA expert. Put it at the lower end of farm credit, certainly wouldn't it, if we were at $100,000. That would be only at the resident farm.
Our direct lending in the 300.
Okay. So we would put it at the lower, you know, the lower end. And though again, it couldn't, you know, it would not supplement for, I think, many government programs. So it could probably be a little more flexible. Would be a difference. It could be more flexible in some cases.
In terms of,
Please, of course.
on the comment with crowdfunding, you want to just do the starter fund, where you
Sure.
do it as an expansion option. A growth.
Yes. Yeah, sure. It could easily be and I think crowdfunding, you know, would be actually, it's a very good point because crowdfunding for substantial amounts or even land access, I think would actually be pretty difficult.
Yeah.
No, it's a very good point.
It's very suitable.
Yeah, small and unsecured and not, yeah, that's a good point. Okay, great, thanks.
Thank you so much, Scott.